What's up everybody? Nate here. So finally, in March of 2022, we are starting to see some noticeable shifts in the housing market. Earlier this week, the Federal Reserve made some pretty big announcements on what they're going to do with interest rates. And all the way back last week, the Federal Reserve actually started to move interest rates up. Now, the Federal Reserve moving up its interest rates means that pretty much everybody else is going to start moving theirs up as well. And we're starting to see that in the housing market right now. Now, mortgage interest rates have a pretty big impact on what the future of the housing market is going to look like. More specifically, they have a pretty big impact on buyer demand throughout the United States. If interest rates continue to go up, well, then you could start to see home buyer demand slowly drop throughout the country. So does that actually mean that the housing market is finally going to start cooling off? Well, it's kind of complicated. And even though we're starting to see interest rates go up in the United States, home buyer demand might not disappear like we thought it would. But with that being said, today I want to talk all about the housing market. I want to go over these brand new changes by the Federal Reserve, and I also want to talk about where mortgage rates are right now and what that is all going to mean for buyers, sellers, and the real estate market in the future. But before I get into all of that, do me a quick favor and hit smash or destroy that thumbs up button below and ring that notification bell too. Both of those two things are completely free and they help to show me that you like this video and that you want to see even more just like it. Thank you so much for doing that. Now let's talk all about the housing market and some pretty big changes to interest rates and mortgages for 2022. All right, so the big thing on everyone's mind when it comes to the housing market has been prices. As we've seen over the last 2 years, housing prices have gone insane, with some estimates saying that they've gone up by around 18 to 30% since 2020. Now, there are some pretty big reasons for this. Obviously, inventory in the housing market is low. People have been selling their houses like crazy because you can get such a huge profit out of your home. Also, we've had home buyer demand that has gone through the roof. When the pandemic started back in March of 2020, the Federal Reserve dropped its benchmark interest rates all the way down to 0%. Now, that meant that anybody could go out and get a loan, particularly a mortgage, at a super great interest rate, saving them hundreds of dollars every single month and hundreds of thousands of dollars over the lifetime of that loan. And people love spending money in the United States, but what they love more is saving money. So that way they can go out and then spend money on whatever they want to. So those kind of things have been in competition over the last 2 years, but as of March 2022, that is all about to change. The Federal Reserve announced that it's raising its benchmark interest rates by around 0.25% immediately. And that's not all. The Fed wants to raise its interest rates 6 more times between now and the end of 2022. And again, that's not all. They want to have 3 more rate hikes in 2023 and then just about 1 in 2024. So all in all, we could see 10 plus rate hikes between now and the end of 2024. I mean, they did say they were going to get aggressive. Now that has a lot of implications on our economy and the United States as a whole, but today we're just going to look at how that is going to affect the mortgage and house market in the United States. For one, raising interest rates means that people are going to have to pay a lot more for their mortgage. Over the past month or so, interest rates have gone from around 3.1% all the way up to around 4.2%. That is a pretty high increase in just about 30 days. But it means the average payment on a $500,000 house goes from around $2,100 to $2,400. And that might not sound like a big jump right now, but this is only beginning. This is the first rate hike from the Federal Reserve. Now, I will say banks and financial institutions have known for a while that the Fed wanted to raise their rates. This is all in a response to inflation. The Fed wants to bring down inflation and it wants to bring down demand in our economy, so it raises up its interest rates. It's been talking about doing this for a long time to give banks, financial institutions, and the stock market adequate time to kind of get themselves ready for all of these rate hikes, and now it's finally starting to bring them up. So doing that and bringing down demand is also going to bring down demand in the housing market because, for one, people are just going to be ineligible to get a mortgage. I mean, when you get a mortgage, you basically look at the price of the house and what your interest rate is going to be. That's how the bank can actually tell if you can afford that mortgage. They're then going to look at all of your financial responsibilities, so all of your debts and all of the monthly bills that you have to pay in order to survive. Then they take all of that information and calculate calculated alongside what your average mortgage payment is going to be. In order to figure out how much house you can afford, the bank is going to look at your debt to income ratio. And for most lenders, that shouldn't be over 36%. So they look at the 28/36 rule. A maximum of 28% of your overall income should only go towards housing expenses. And overall, you should not have more than 36% of your income locked up in debt. If you do, then you're not going to be able to get that mortgage. So when you go to a bank and you try to get a mortgage, they're going to look at your debts and they're going to look at what your proposed mortgage is going to be. And if it's more than 36% of your overall income, then you're not going to be able to afford that house. And remember, this is all monthly income, so everything that you make every single month. So what I'm getting at here is that if a house that you want costs $500,000, but the bank isn't willing to give you that loan simply because the interest rate is now too high, well, you're not going to be able to get that house. And the crazy part is, if housing prices continue to go up, then that $200,000, $300,000, $400,000, and $500,000 house might be the only thing on the market. Buyers are simply going to be priced out. They cannot afford a home by bank standards. And of course, that's the bank standard side. Even if you are able to afford a home, some buyers just aren't going to get one because now they're overpaying for the price of a home and the mortgage rates are so high. So they're spending an extra $100, $200, or $300 a month simply to get a home. That is something that a lot of people can't afford right now, considering inflation is hitting new record highs every single month. So ultimately, that is going to bring down homebuyer demand. You're not going to see as many mortgage applications spike in the United States, and we're already starting to see that because compared to this time last year, homebuyer applications are actually down by around 8%. People aren't looking to get a mortgage right now because home prices are so expensive and mortgage rates are pricing them out of the market. And interest rates are going to most likely continue to go up in the future as the Fed wants to raise rates even faster. And with that being said, this is a really weird situation for the housing market because even though a lot of buyers are going to be priced out of the market and mortgage rates are going to continue to rise, most experts believe that home prices and the housing market is still going to be hot for the foreseeable future. And the reason for this is more of a psychological one because now you have millions of buyers all throughout the United States who are worried that they're not going to be able to afford a home in the future. So what are they doing? They're going out and trying to buy a home as quickly as possible right now. They want to get that home before interest rates go up even more because right now, while it might be a little difficult for them to get that house, they want to try for it because a year from now, it might be impossible. So home buyers are going out and buying homes still. So that might mean that the spring and summer months of 2022 remain hot for the housing market. And the other thing you got to remember is inventory is not getting better in the housing market. We've seen sellers put fewer and fewer homes on the market pretty much every single month. And on top of that, buyers are buying up everything that is available, pushing prices higher and higher with every single deal. So that's kind of the weird dilemma that's in the housing market right now. You've got the Fed trying to lower demand, but in doing so, short-term demand is actually going to spike according to some experts. Now that is in the short term. In the long term, demand is eventually going to lower in the housing market because like I said before, mortgage rates are going up. And eventually, that's going to mean that people simply can't afford to buy a home. More importantly, banks aren't going to let them get a mortgage because their debt to income ratio, according to the 28/36 method, isn't going to allow any extra room for a mortgage payment. But there are still going to be institutions and home buyers out there that want to purchase homes, meaning that the inventory is going to get even smaller and prices are going to get even higher. Now, if there is just one thing you take away from this entire video, remember this. Every single major real estate firm in the United States is not predicting a price plummet in the housing market this year. And the reason for that is because there is just simply not enough homes on the market. Because of all of the stimulus and low interest rates and an abundance of houses on the market in 2020 and the early parts of 2021, now in 2022, there's just not enough to go around. That means that even though demand is expected expected to drop, it's still not going to be anywhere near where inventory is right now. Even if demand goes way down in the United States, inventory is going to remain extremely low. So housing prices are going to go back up. And you got to remember about what happened in 2020. The United States federal government gave out thousands of dollars in stimulus payments. But here's the thing, that was one single payment. So Americans in 2020 could take advantage of low interest rates and stimulus payments in order to buy a home. That was basically their home starter fund. However, those payments eventually went away. So Americans couldn't use them to buy homes anymore. And now with interest rates going up and Americans having to use only the amount that they have in their savings account, well, they're gonna be pretty strapped for cash. And fundamentally speaking, what experts like to do when they talk about how high prices will go in a particular year is they compare the housing prices and the trend of how they are going up versus incomes. If incomes in the United States continue to rise, then it's only natural to think that people can afford to buy more, and that includes homes. However, housing prices have massively outpaced the rise of incomes in the United States for pretty much the last 2 years. Simply put, that cannot continue in this current housing market. If incomes don't go up, then housing values cannot go up either, because Americans just simply can't afford to pay what houses cost right now. Of course, if incomes do go up, then that would mean the housing market is going to continue to be overinflated in value. The homes might not actually be worth what they're selling for, but they're going to continue to go up in price because people got money to spend. Eventually, you're going to have housing prices continuing to go up because inventory is always going down, and demand is going to go down too because mortgage interest rates are just pricing people out of the market, along with home prices. That means eventually we have to see a cooling off in the housing market. I mean, there's just no other way unless we have more government stimulus or a lowering of interest rates. Now, don't get me wrong, we could see interest rates go slightly lower over the next few months depending on buyer habits. If demand goes way too low all at once, then banks are going to kind of want to incentivize people to go out and get homes by lowering their interest rates. That might be for a week or 2 weeks or a month at a time, but it's not going to be something that we see for the foreseeable future, at least not given the current trends of the Federal Reserve and the housing market. Some are now predicting that we could see a 25% drop in the sale of homes by the end of the summer because demand is just going to go too low, the Federal Reserve is going to raise their interest rates too high, and prices are going to continue to spiral out of control because people are still going to buy homes and there's just not enough inventory on the market to meet even that lowering of demand. So what exactly are my thoughts on the housing market? Well, I don't think we're going to see an outright crash in the housing market because conditions just aren't there for it. I mean, yes, you're going to see lower demand, but people are always going to buy houses. Incomes are starting to go up slightly in the United States, so as people make more money, they will eventually start buying more houses. And in the short term, that means more people are going to purchase homes. People are scared right now that they're not going to be able to afford a home a year from now. And that's a pretty realistic expectation considering how aggressive the Federal Reserve wants to be on inflation and wants to raise their interest rates. But an outright crash, I don't think is going to happen in the housing market. I mean, unless we start to see millions of people not able to afford their homes, or all of a sudden, millions of people not able to purchase any homes. With that kind of demand lowering that quickly, then you'll start to see prices immediately and rapidly drop in the housing market. Again, they'll most likely continue to go up in the short term. However, we're not going to see an outright crash like we did back in 2008. Back in 2008, there was a lot of other problems with the housing market, and a lot of the safeguards that are in place today just simply didn't exist all the way back then. Now, banks and financial institutions make sure you can afford your home before you even buy one. So all the people that are buying homes, for the most part, can afford them. That doesn't take into account how bad inflation can get, because if inflation gets even worse in our economy, well, then nobody's going to be able to afford anything. At the same time, though, that's why the Federal Reserve is getting aggressive with inflation in the first place, so they can lower demand now. That way people can eventually start buying things at a normal rate again. Oh yeah, demand is most likely going to spike for the next few months, but eventually it's going to come down. Inventory is going to remain low, so prices are going to remain high. Mortgage rates in the United States are most likely going to continue to go up, which means eventually the housing market is going to cool off. I don't even think it's going to go into correction territory. I think eventually prices are just going to level out, and then they'll start going back up at a normal rate as more people are able to get into homes again. But now I want to hear from you on this issue. What do you think about what's going on in the housing market right now? Do you think that homebuyer demand is eventually going to completely disappear as interest rates start to rise? Or do you think that the housing market is going to continue to be hot for the foreseeable future? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another update ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.